If you have a high deductible health insurance plan, HSA is a wonderful, wonderful way to not only put money away for medical expenses, but really ideally, I say start an HSA if you have a high deductible health insurance plan. And if you don't need to take money out for your medical expenses, let it grow. It's not like an FSA where it's use it or lose it.
Welcome to Spur Equity's Spur Your Wealth podcast, your ultimate guide to passive income through real estate investing. Join us as we together discover the secrets of building wealth one passive investment at a time.
From expert insights to inspiring success stories, this podcast will inspire you and empower you to take control of your family's financial future so you can live life on your own terms. Welcome everybody to Spur Your Equity's Spur Your Wealth podcast. I'm your host today, Rav Singh from Spur Equity. As always, on our podcast, we aim to bring successful investors and experts to share their secrets and journey so we can all stand to benefit from their experience. On today's episode, we're excited to have Angie Bhasin. Angie is a good friend of ours. She's not only a real estate investor, but also a certified public accountant practicing in California since 2002. Angie is nationally recognized certified tax planner who has helped her clients save hundreds and thousands of dollars by proactively employing IRS-provided tax strategies to reduce taxes. She knows how to leverage every available deduction, legal loopholes, and credits to growth generational wealth. I'm really looking forward to having a casual, important, and time-sensitive conversation with you, Angie, as we're at the end of 2023. A lot of people in our network have questions about taxes, how to save on things, etc. So I just want to say thank you for being here today and look forward to having this important conversation with you today.
Absolutely. Thank you for inviting me. I'm happy to share my experiences and my thoughts on investing and taxes. That's my favorite topic. You know that.
Awesome. Yeah, absolutely. Absolutely. So let's get started. We want to know who Angie Bhasin is. So if you want to give an introduction, let us know, who you are, what you do, and why you do what you do.
Absolutely. Absolutely. Thank you for again. So who I am a mom of two beautiful daughters. I'm a wife of an awesome husband. I live in California. Well, I grew up in India. I was born and raised in India, but I've been here longer than I've been in India. So, on the personal side, and then on professionally, like you said, I have been practicing as a CPA since 2002. And even though I started off as a traditional CPA, right? And what I mean by that is, as CPAs, we're more of historians, taking historical data and accounting for it, and then putting numbers in boxes and preparing tax returns with historical data. Even though I started off as that, over the years, realizing even though that's a very valuable service that is needed to make sure that tax returns are prepared correctly and timely, it leaves a lot on the table. And I've worked at large firms and small firms, and I'll tell you this, all 100% of CPA firms will tell you that they do planning.
Yep.
But having come on this side, now specializing in proactive planning, in addition to being a CPA, I'm a certified tax strategist. And being on both sides, I know the level of planning that is done traditionally by CPA firms is nowhere close to what is needed by hardworking taxpayers.
Mhm.
As CPAs, our training is more to compliance related, right? Filling out tax returns. I always used to say, at least as CPAs, we do the tax returns accurately. But I'll also tell you this, in my experience, when I look at tax returns from prior years, not only obviously the planning concept is not there, but there's so much money left on the table because of missed deductions.
Oh, yeah.
We've been able to help our clients, and kind of segmenting into what our process is at our firm. When we start talking to a new prospect, my objective is to look at their prior year tax returns review for any missed opportunities or mistakes. And
Hmm.
believe you, it's mind-boggling how many times I see mistakes that my clients are able to get refunds even before we decide to work together. So I've just decided to make that part of my way to kind of give back. So whether we decide to work together or no, I will review the returns and share my findings. Just earlier this year, this new client came in from a fairly large firm. So this is why I say, even though I start saying prepare accurately, but that's not even on the table, right?
Right.
All the time. You have to be careful with that. She overpaid her 2020 and 2021 taxes by about $89,000 in 2020 and $92,000 in 2021.
Wow.
Big chunk of money when you're working hard for your money. I mean, any amount of money is big money. So we were able to help her amend her returns and get those refunds even before we got started on 22 compliance. So
Okay.
that really is, and that alone is valuable. But then going forward, planning
Yeah.
with her, strategizing based on her situation, her goals and needs,
Yeah.
how can we carve out these deductions from the code, and especially when you have a business, and especially
Right.
when real estate can be
Hmm.
considered a business
Hmm.
in the right circumstances. The code is is filled with deductions that are available.
Available. Right.
Congress incentivizes
Hmm.
businesses and growth, so
Hmm.
that's where most of the code is.
Hmm.
But you have to have the knowledge, and then second, the capacity to invest yourself and your time to intentionally carve out these deductions to fit in in your particular
Yeah.
situation, right? Everybody's situation is different.
Right. Right.
And that's not only just the focus of my firm, but that really is a passion of mine. So
Hmm.
I've we've done several webinars together, and I do
Hmm.
this invariably all the time. My goal is to educate. I cannot work with hundreds and thousands of clients. I'm a boutique firm,
Right.
and that's how I like it. But my goal is to educate way more than hundreds and thousands of taxpayers, because I
Hmm.
really feel this is a big need.
Yeah.
Education is the first part. When you don't know what you don't know, then you don't know what's out there for you, right?
Right. Right.
So I'm big on educating not only taxpayers, but I mentor other CPAs,
Hmm.
um, kind of getting this up into our realm of services.
Wow, that so you mentioned a lot of things here, right? So thank you for the introduction.
Absolutely.
I think a lot of our journeys are the same. What I mean by that is by saying that as immigrant families, we've left countries, we've come to other countries for betterment of you name it, right? Everything pretty much. And so the fact that you're here, you are a professional, you've gone to school, and now not only are you doing your business, but your passion is really serving and helping and educating people regarding obviously what you do, which is on the tax side of the equation.
Right.
And so thank you for sharing that with us. I think that's very important. Growing up in the families that we've grown up, and I've seen this, and now in the capacity of where I work, working with some of these investors, I feel like a lot of people say, "Hey, look, I can do my own taxes. I can run to like H&R Block or another tax services that are basically they're just meeting once a year for 1 hour and filling out information and spitting out a tax return which they're filing, right? My assumption is if people have a W-2 job, that may be fairly simple. But if people have a W-2 job and then they have a side gig, maybe they have a business, or maybe they're full part-time investors investing in deals, then at that point, maybe there's some other knowledge that they need to gain to speak to folks like you to see what other savings they can do in regards to getting those deductions that you're talking about. Because I feel like it's so important for folks to have that knowledge, yet they simply just for ease of convenience or for better not getting educated. They just run to, spending 1 2 hours and filling out their tax returns and getting done with things. So what would you say to folks who are just starting, maybe thinking, well, maybe next year I want to do something different. I want to maybe go talk to a CPA or talk to an accountant and see what else can I save, how else can I save. What's the advice that you would give to an individual who's just first starting out?
Thank you for bringing up that question. That's an excellent question. And of course, any question that I can get where I can share my little bit of knowledge, I'm happy to. And you bring up a really good point about tax preparation and tax and for thank you for making that distinction, because tax preparation is very distinct from planning, right?
Mm-hmm.
When you're doing your tax returns, it's generally after December 31st in the following year. There is no planning happening at that point,
Right.
because the year is
Is
closed,
done.
right?
It's
It's
complete. Yeah.
so planning is always proactive. Now, as far as using something like TurboTax or H&R Block, I think if your situation is simple enough, like you said, you have a W-2, maybe you have a home and you have a 1098 for mortgage interest and you have some property tax, pretty simple, nothing else
Mm-hmm.
happening there. And even at that, even the W-2 wages from an uncontrolled corporation are fairly on, I would say, moderate level, not in a high, if you don't fall into the high income level, you're okay with using TurboTax, because there's not much you can do in terms of tax strategy to reduce your taxes. There's never an always answer in our industry,
Mm-hmm.
right? It all
Right.
depends.
Right.
It all
Right.
depends on
Right.
your situation. So as I
Pertinent
started out to
situation.
say that sentence, and I'm like, no, no, no,
Yeah.
there could be possibilities. But in general, I'll say in general. But again, if you fall in the higher income wage, if you're a higher income wage earner, then there is planning opportunities. Though, like I mentioned, most of the code is geared towards providing these tax benefits to business owners or investors. There is also the availability when you have more disposable income. So if you fall into the high wage earner, even though you don't have access to the strategies that you normally would if you operated a business or you own something like that, you have disposable income. So then there are these tax advantage alternative investments that you can invest in that
Mm-hmm.
will bring your tax liability down. So there is that option. So in order to answer your question, if your income is on the lower end, not much of disposable income, cash
Mm-hmm.
flow, perhaps that's okay. And as I was going to say, even then, there are opportunities, because maybe if your income is at a lower level, then there's planning around, especially now, right? The EV credits,
Right.
they are income threshold limited. So if whether you can qualify for those credits or no, and whether you can, even if you're maybe on the threshold, maybe you can stack on some alternative investments, drive that taxable income down to a level, then you can take advantage of the credit, right? So there's
Mm-hmm.
there's just so many things that can be done. But in general, for the most part, if you have a lower income, and it's certainly after the end of the year, if it's after the end of the year, doing your tax returns on TurboTax or something makes
Right.
sense.
Makes sense. Makes sense.
But if
Right.
you are higher wage earner, especially if you have a business or you have real estate or you have
Mm-hmm.
these other investments, I think it would be very short-sighted to just think about preparation at that time,
Mm-hmm.
because
Mm-hmm.
sure, you can go get your tax return prepared in $500, $1,000, or whatever that is. But if you're leaving money on the table, it's not costing you just that 500,000 or that's $1,000. It's that plus what you're leaving on the table with
On the
additional
table. Yeah. Yeah.
taxes.
I bet you, if you look at it from a percentage standpoint, based on years of business that you've done, there's so many people who fall in that category
Oh, yes.
that basically just think that they've maximized everything because they're doing it themselves and they're smart enough, and they may be. Folks out there that are doing that, but a lot of people are just leaving that money on the table, not knowing what they don't know, as the example that you just gave earlier today.
I can tell you, I have yet to come across a tax return that I like there's nothing I can do here. There's
Yeah.
always what you can do. Now, perhaps it's not a right fit for our firm to work with a client that doesn't have too much that we can help with, right? But there's
Hmm.
always savings on the table. Maybe it's
Right.
not us, maybe it's somebody else. It'll be worthwhile to help them save $5,000, let's say, right?
Hmm.
But it's still $5,000,
Sure,
right?
absolutely.
And
So
that
what
adds
I
up,
just heard from you is that tax planning is a must,
is a must.
regardless if you end up taking the advice or doing whatever you need to do, but at least go talk to folks like yourself or anybody else local in their market
Yeah,
just to see, look, and this is what I've been doing for the last few years. What do you think? Is it fine I keep on doing it, or is there anything different that I need to do from a tax saving standpoint at that point? Um,
exactly. And
yeah.
make that distinction between a tax preparer and somebody who is a forward look thinking
Mhm.
planner. And yes, please do get a second set of eyes looking at it.
Absolutely. Thank you. Thank you for mentioning that. What about like some low hanging fruit advice that you want to give to somebody, even regardless if they're on a W-2 and that's it, versus they're investors or they have businesses, in regards to, what are the tax free buckets that they can put their money in so they end up paying less money, and I don't want to talk about like loopholes or anything like that, but in general, like people, I feel like, a lot of times, I being a real estate broker, obviously I interact with a lot of agents in my office and other offices, and then when we start talking about stuff like, what we are doing or what Param and I are doing through Spur Equity, I feel like, some of these folks, even though they're in their own business, they're not maximizing some of that stuff. A lot of people don't know what a Roth might be versus a regular IRA, or a lot of folks aren't putting money away because of their retirement, that then they're not thinking. What are maybe, a few things that and from an advice standpoint, you would give to an investor who's starting on this journey, or somebody else, who's thinking, well, yes, I'm making money and I'm going to just put from the top line, give so much money to Uncle Sam, but how can I reduce that? What are some of the benefits that you can share with us on that?
Sure, sure. I can mention a few low hanging fruit, as you said. So one of the first few things, especially as you're first starting, and perhaps your income is, combined income is, again, you'll have to see where that lies. But if it's within the threshold, can you make a deductible IRA? Can you maximize that? Of course, you must be maximizing your 401k at work if that's provided.
Right.
Um, HSA,
Hmm.
if you have a high deductible health insurance plan, HSA is a wonderful, wonderful way to not only put money away to for medical expenses, but really, ideally, I say start an HSA if you have a high deductible health insurance plan, and if you don't need to take money out for your medical expenses, let it grow. It's not like an FSA where it's use it or lose it.
Hmm.
It is supercharged Roth IRA. Basically, that's what it is, because you get a
Hmm.
deduction going in.
Hmm.
You get a tax deduction for it as you're going in. It grows tax free. And when you take out that money, maybe 20, 30, 40 years down the lane for medical expenses, it's tax free.
It's tax free,
So
right?
you let that grow, and talking about that, investing in those, right? Going into maybe like self-directed, in a way. But another option, I think you will really relate to this. I like yourself, I'm very pro real estate. I think
Hmm.
that's a great way to build generational wealth, as well as take advantage of, other people's money. You're financing, you're not putting 100% into a deal, you're utilizing leverage. It's really, obviously, in the right investment, you got to do your due diligence. And it may even bring tax benefits, right? If your income is below $150,000 and you're investing in real estate and you're generating these paper losses, aka depreciation, that's going to bring you losses, you can
Hmm.
actually write that off against your income. Now, as your income increases, and then we get into section 469, which is passive versus active or material. Let's say there's a W-2 wage earner. They're working full time in their business, at their job place. but they invest in real estate, it's considered passive for them because it's a side activity for them. So
Mm-hmm.
if they're
Mm-hmm.
creating losses there, they and their income is above the threshold, they cannot offset that losses against their other income. But they it's not like those losses get lost, right? They
Mm-hmm.
sit in a bucket,
Mm-hmm.
accumulate.
The
When they sell that
carryover.
property, they can offset that. So that can be super powerful.
Mm-hmm.
So tax benefits, cash flow, real estate is a great way to generate cash flow. And retirement. I
Mm-hmm.
mean, consider when you have a 401k, when you turn that age, right now it's 72. Of course, they're increasing it to 73, up to 75 over the next few years.
Mm-hmm.
You have to start taking RMDs, required minimum distributions.
Right.
When
Right.
you have real estate, you have full control over what you do with that cash. Nobody's mandating that.
Mm-hmm.
As by default, we are practically all invested in the stock market. I think it's a great way to spread out your risk and not have all your eggs in one basket. And
Mm-hmm.
real estate is a great opportunity to do that. Anybody starting now, my daughter is.
Mm-hmm.
I think she may have listened to me a whole lot. She's like, I need to build a real estate empire. So she's young and she wants,
Mm-hmm.
and I encourage everybody to be thinking that
Yeah.
way.
No, thank you. So I think great advice. You've covered a lot, and so what I want to do is just spend maybe the next few minutes kind of talking about that. So let's take it section by section. So first of all, a lot of investors that invest in just the market, let's say in the equity side of it, they're investing in stocks and mutual funds. They understand that because I think that's more something that they've done it for a
Mhm.
long time. A lot of our investors come from IT, from the tech world, or they're business folks, or people who are in the W-2 job. For some reason, a lot of time real estate becomes very complicated for them because real estate's not taught on CNN. Real estate's not taught on
There's a
CNBC.
reason for that, right?
Right, right. But they see a lot of people getting into
Mhm.
Warren Buffett and others, investing in all that. So an example maybe that if I can share and tell me if I'm wrong or right on this is the fact that if I, as an investor, I invest in stocks and mutual funds, and I'm an investor and I make lots of money. At the end of the day, when I sell to make money, I have to probably pay a capital gains tax on the money that I'm making, right? And so
Mhm.
if I have to pay that tax, I have no problem because I'm making money, therefore I have to pay taxes. But if I have to save those taxes, is it appropriate for me to say that, while I'm still in the stock market, stock side of things, buying and selling and making money, on the other hand, if I invest in real estate investment in a syndication, which may generate a passive loss, here on my stock side, I've made money and I have to pay capital gains taxes. And on the other side, on the real estate side, I've generated a loss, a K1, which might come negative, whatever. Can I offset my gains on my real estate side or on my stock market side with the loss that I have on the real estate side?
No, unfortunately not.
Because a
It,
lot of people have that question. A
yeah.
lot of people ask that question to us.
And that's what I refer to Code Section 469. That's where it implies those regulations. Because before Code Section 69, 469 was passed, I think it was in the 80s, I forget what year. That's actually was a biggest loophole at that time, right? These very well-to-do W-2 wage earners, physicians and attorneys. That's what they were doing, generating high income, whether it was ordinary income or capital income, doesn't matter. Buy
Hmm.
some real estate and offset those losses, but that's not allowed. So,
Hmm.
and the reason for that is exactly what you said. If you're investing passively in real estate, it's a passive activity
Passive activity.
versus let's say you have a business or you have a W-2, that's ordinary income. There's different buckets of income. And then gains on capital investments, that falls in a separate bucket, which is a
Hmm.
capital investment. So you can offset capital gains against capital losses,
Hmm.
and up to a $3,000 a loss you can carry in 1 year, but you cannot offset that against passive those gains against passive
Right.
losses, and neither can you offset ordinary income, which is from your W-2 or even business income flowing through to you
Hmm.
against these passive losses,
Hmm.
because there's rules in place for that. However, having said that, those passive losses are still very valuable for when you sell that activity, or if you have passive income coming from another source.
Hmm.
So that's a question. You're right. That's a question a lot of people have, and it's
Hmm.
something that a lot of people have a little hard time getting their hands around it. But again, like as I mentioned, if you have passive losses and you're below that income threshold between 100,000 and $150,000 of income, then you can use those losses. There is um, another way that you can use those losses, but then
Hmm.
again, that's not available for a W-2 wage earner.
Right.
And that goes into real estate professional status.
Professional.
But we have several clients,
Hmm.
one spouse is making a high wage earning, the other person can qualify as a real estate professional. So that really opens up a lot of opportunities to then take what I call um, the best tax marriage,
Oh yeah.
right? Because
Oh
then
yeah.
you combine those two strategies together,
Sure.
and we have several clients who actually qualify to do that, and that's the process. There's rules in place that you have to kind of go through to make sure that you qualify for a real estate professional
Hmm.
status. um, and I'm big on documentation, and that's also the other huge benefit of proactively planning, because not only are you intentionally carving out these deductions from the code to apply in your situation, but since you're intentionally carving out, you know
Hmm.
exactly what the IRS is going to want to see in your documentation, right? So that helps you substantiate your position now versus 2 years down the lane, which I don't know about you, but I don't remember what I ate for dinner last night.
Yeah.
So I'm not going to be able to do anything with that then, right? So, and
Document,
so
document, document.
document, document,
Yeah.
document. But great question you have. And
I was going to say, because I think a lot of people have a confusion on that, right? Real estate is amazing to get obviously passive income and
mhm,
also generate passive losses.
mhm,
But then each situation is different, as you just mentioned.
correct. Yeah.
We have so many clients, so many investors that invest with us at Spur Equity, that they invest because not only do they want to make money, but it's also a tax benefit for them. And specifically with us purchasing properties and doing cost segregation and accelerating the depreciation and giving, let's say, negative passive losses to our investors. Well, that's a strategy for that investor because, as you said, maybe a couple has a full-time job and they're high earners, wage earners, and the other one, it just makes sense for them to get into the real estate side of the
Hmm.
equation,
Hmm.
and become a real estate professional, so that they can now actively take that passive loss against their active income at that point, right? And so,
Absolutely. And I do want to make a point, because a lot of times people hear real estate professional and they think, oh, I need to go get a real estate agent license, and that's going to qualify me as a real estate professional, which is not true.
mhm,
You don't even have to have a license, but there's hours requirement. You need to spend at least 750 hours in real estate activity,
yeah,
and more than any other. So you may be you may have a part-time W-2 job, but as long as you're spending more than that, what you're spending in that job in real estate, and
mhm,
750 hours in real estate, you
mhm,
qualify for the real estate professional status. But
yes,
in order to take those losses, to be able to deduct those losses, there's another test that you have to
yes,
pass, and that's
yeah,
the material participation test. So a
correct.
lot of people forget that there's two tests that need to be passed,
Mhm,
and material participation is there's seven ways of qualifying. Generally it's about the one that's mostly used is 500 hours of material participation in managing real estate activity,
mm,
and
mhm,
then you can, but done right. And if somebody who's really motivated to do that, I mean, I have a client who is a radiologist. I mean, they make great money, and the wife is has qualified. We helped her because it's a little bit of education. On that note,
Sure.
we're coming out with a training portal on this, where I lay out step by step the rules, the laws for qualifying as real estate professional, and what you need to do in addition to other training
Right.
material, because I feel like this is such an important part of the tax code.
Hmm.
um, so yes, but if you do qualify, and if you dot your i's and cross your t's and get over that threshold, it can be huge.
Great
Yeah,
savings for you.
yeah,
Absolutely.
great
So
share.
thank you for mentioning that, because I think it's just a learning process, and it's a
Yes,
learning journey that people need to
yeah,
understand. And so the more they know, the more they read, the more they talk to folks like you. I think it's better for them and their families and the future generations, because once
absolutely.
again, you're leaving money on the table. And why leave money on the table when the rules are there, meant for you, meant for, IRS has made those rules for you. I mean, depreciation, as I understand, is something that IRS basically tells you that you have to take, right? It's something that they've
Exactly.
designed it for you to save money, actually.
Yes, it's allowed or allowable. So there have been cases I've seen tax returns where, for whatever reason, the prior accountant didn't take depreciation. Now, not only that did not help the client in the year in which the depreciation was not taken, but when you go sell,
Hmm.
IRS is going to account for that. He's going to say you have to account for that depreciation that you didn't take. So it's like, what double
Right.
whammy here?
Double whammy, right? Yeah,
Yeah,
right, right,
yeah,
right. Yeah,
yes,
no, I agree. So thanks for doing that. And I think what we'll do is, as I said, we're planning next year to do a lot of educational content. So I think this will be great to kind of speak on, and maybe we'll have you back
sure,
on a webinar where we can, answer these specific things. And I know people will have specific questions, so investors can be on it, and then we can have a live chat discussion on this. A couple other things I want to talk about. I know our time's almost being up here, but I wanted to kind of talk about a lot of folks. They're working hard, and they're putting money away for retirement, right? And that money that's put away for retirement, yes, gets invested into equities and all that. And you briefly touched it, that some of that money can also be used for buying property or investing in real estate. If you could spend the next few minutes kind of talking about what's an SD IRA and what's a regular IRA, and how can they invest in real estate?
sure, sure. So regular IRA, different. You got to differentiate it from a 401k.
Mhm.
401k is generally with an employer, right? You're working with a company. They have a 401k. You're contributing to it.
Right.
On the other hand, you can invest in an IRA, or you can contribute. Sorry, contribute is the right word, in an
Hmm.
IRA, um, whether it's a tax deductible or a Roth or whatever that is.
Hmm.
Right now, however that came into being is a different matter. And let's say I'm just kind of going through the different ways how you can get to an IRA first,
Right.
and then I'll
Right.
answer your question. Let's say you changed your employer. Now
Hmm.
you have the opportunity to roll that 401k into an IRA. So once it gets
Right.
into an IRA, then you have an opportunity to self-direct that IRA, meaning
Okay.
that's what the SDIRA is, a
Hmm.
self-directed IRA. Now you have to go through a third party. It has to, you have to follow all the rules regarding
Hmm.
this. So it goes to, you've worked with
Yep.
different SDRA
Hmm.
firms. So it's a third party administers this your self-directed IRA, but you have the opportunity to then use the funds in your IRA to invest in, whether you want to do real estate, invest in an investment of your choice rather than just in the equity market that
Right.
your 401k would be invested in. That can be very powerful.
Hmm.
You all Obviously you have to, this is not investment advice, so you
Hmm.
have to be careful of what you're putting the money in, and consider it's your retirement fund, so you want to be not too aggressive with it,
Right.
right?
Right.
So all of those things you want to keep in mind, but it can be enormously beneficial, because
Yeah.
let's say you use those funds in a SDIRA to invest in a multifamily syndication. 2 years down the lane, you dispose of that activity, you realize this huge gain. It's not taxable to you because
Hmm.
it's within the walls of the IRA, and
Hmm.
you're retirement fund is just growing from there. One, I guess, disadvantage in a way, but not really if you think about it, is since it's not taxable entity, you
Hmm.
don't get the benefit of depreciation,
Depreciation,
right?
of course.
Which,
Yeah, yeah.
which if you think about it, when you're going to sell, it's you kind of true it up anyways, right?
Hmm. Hmm.
But a lot of times people will say, oh, I'm not going to be able to use depreciation. You're not going to be able to access the benefit of depreciation anyways, because it's passive, right?
Yeah, right. Unless you're
Unless
the real
you
estate
qualifying
professional.
to be,
Correct.
yeah, make that
Correct,
non-passive.
correct, and that's great. I think, as I said, that a lot of people, either they have a confusion or they may not have knowledge enough that you can take your IRA, that you have a bucket, and that bucket has a bunch of money that's in there.
Hmm.
Either keep it the way it is, and whatever return you're getting, it's fine. But you can take that and roll it over into what you're saying, a self-directed IRA. And
Hmm.
now you, as a beneficiary, that's your money, but it's your retirement money.
Correct.
That bucket, now you're self-directing it, that can invest into different forms of alternative investments, real estate being one of them. And so any gains that you get will go back into that bucket again. And let's say I doubled my money, well, I may not have to pay tax on it because it's going back into that IRA. And if it's a self-directed, maybe Roth IRA, that's already pre-taxed.
That's
Now,
like the best of all worlds.
right, because now whatever's growing in there, let's say I have $100,000 in the self-directed Roth IRA that I converted, right, and I pay taxes on it. Whatever strategy wise, they need to talk to you or their CPA. But once that is there, and fast forward, future thinking, 10 years, 20 years from today, that 100,000 grows into, let's say, $1 million,
Hmm.
with
Tax
different,
free, tax
and that's
free.
tax free. So when you're taking that out, you're paying zero taxes on
Yeah,
it, because on
yeah,
100,000 you had already paid taxes on it
yeah,
before.
yeah.
And so these are the type of strategies that people need to talk to folks like you to understand better. Every situation is different. Everybody's different, right? Their
And
bases are going to be
everybody's
different.
situation changes from year to year, right? So
Right.
to kind of follow up on what you said, again, this is where planning is so important. Maybe this is a dip year in income for you, right? So this may be the year that you convert your traditional IRA into a Roth IRA,
Roth IRA,
right?
right.
Utilize those lower tax brackets this year. So it's just there's so much, and then the combinations and permutations and combinations of planning are enormous. There's, you could stack up different strategies to, one on one hand, lower your taxable income, and then on the other hand, grow your wealth.
Well, yeah, absolutely, absolutely. So thank you again for that. I think that's very good that we had that discussion. One last thing I want to talk about, and I know we briefly touched it in our phone conversation the other day. You know, at our company, we're getting a lot of folks from other countries who are calling us and saying, they're seeing our content, or they're seeing some of the stuff that we're doing online, and they're asking us that they want to invest in the U.S. Then they might be in Canada or Mexico, or any other country out there. Um, uh, and we don't need to get into the details of it at this point. I just want you to let our investors know at a very high level: can international investors, can they invest in America? Can they invest in projects? Can they invest in real estate?
Yes, that I mean, U.S. is for that, open to that. Yes, you can. There is due diligence, and there are regulatory requirements that need to be made. But high
Level, yeah.
high level answer, yes, yes,
Okay.
absolutely.
Okay. So, as we get these questions from our investors, we are going to be looking for professionals who understand this, that we can, match them to those folks that can answer those questions for them. Because we've been hearing from others the same thing, that we have folks who want to bring equity, who want to bring money in the states to invest in real estate.
Hmm.
And so we're happy to explore that. And so as you guys who are listening to this episode, if you have questions regarding that, reach out to us, and we will make sure that we can direct you to the individuals who can answer those questions for you, and even help you within your journey in regards to investing in real estate in the U.S. As a safe harbor. But there's due diligence, as Angie mentioned, and so many other regulatory things that you have to do in order to be compliant with,
Right.
with wherever you're investing. So obviously, do your due diligence. But if you have any questions, do reach out to us, and we'll be able to match you up with the folks that we need to on our side to help you do that. So we're coming to an end on our episode here. Any final thoughts from you to our investors, to anybody who's listening out there regarding, life in general, regarding taxes, regarding, what do they want to hear from you as a final thought, and then also how can they reach you if they have any questions?
That's a pretty good invitation, right? What do I want to say? I say keep learning. I mean,
Mhm.
that's the one thing I think learning is growing. Reach out to professionals like you. If what you don't know, reach out to people who are in the space to understand it. And really, I mean, if you're starting early on, you have a whole length of your
Mhm.
career or lifespan, right? Even if you're starting later, start now, right?
That's right.
It just whenever you're starting, that's the beginning.
That's the beginning of your journey,
Yeah,
correct?
yeah, yeah.
Absolutely. And how do they reach you if they have any questions, if they need to set up time with you to, talk about their journey with you?
Yeah, sure. So our firm, I believe you did mention, it's FinTax CPAs. If you want to reach us, you can reach us at admin@fintaxcpas.com. Um, we're on Facebook. I'm on LinkedIn, YouTube. We still have a bunch of our content that we haven't posted yet, but we
Mhm.
are. What would be really helpful is in early next year, we're going to launch our online training portal,
Okay.
which will be a series of educations in different modules: real estate, business, individuals. I do want to touch on something that you mentioned. You know, I was all negative on that yes, you cannot offset your capital gains against passive losses. But remember, if there's so much strategy and stacking of strategies, if you have
Mm.
a capital gain event, a
Mhm.
triggering event that's generating capital, there's strategies that you can put in place to offset that. So there is never a situation where you can't do anything with it,
Right.
unless it's after the end of the year, or unless that trigger event has happened, right? I was talking to someone yesterday, and they're selling their business for $10 million.
Mhm.
And first of all, I commended them for
Yeah.
thinking now, because the sale is going to be in March, the sale is going to close in March. That's perfect.
Uh-huh.
Because when somebody tells me, oh, I sold my business last month, I'm like, crap, now you tell me,
Yeah.
I mean, we can still do some things as long as it's before the end of the year, but then those options get limited.
Sure.
So think about that, think proactively for your future, and plan proactively.
100%. I 100% agree with that advice. I think the more you can plan, the more you can think about, what lies ahead, the better you would be in terms
Yes,
of that. And
yes.
knowledge is obviously, something that everybody has to get started. We are learning these episodes that we're doing with our investors and with our clients and with our, folks like you who are coming in. We learn so much collectively from each other. So once
We're
again,
always
thank you.
learning. Yeah, I'm
Absolutely.
learning every single day.
Well, good. Well, thank you. Thank
Yeah,
you again for joining us. So,
absolutely.
thank you for tuning in to the episode of Spur Equity's Spur Your Wealth podcast. Again, we are Rav Singh and Param Singh from Spur Equity. Remember, as always, your journey to financial freedom begins with knowledge and action, where knowledge is power, but action is superpower. So until next time, happy investing. Thank you for joining us on this episode of Spur Your Wealth podcast. We hope you enjoyed the valuable insights and inspiration. Don't forget to subscribe to our podcast and stay updated on future episodes filled with actionable tips and strategies.
If you want more information about our investment projects, visit us at spurequity.com. If you have an inspiring story to share and would like to be a guest on our podcast, email us at podcast@spurequity.com. Until next time, happy investing.